Trump's objective here was to stop the flow of fentanyl and illegal immigrants into the country, this tactic seems to be paying dividends immediately. And obviously the markets are now whipsawing all over the place because this idea that we were suddenly going to have this massive increase in cost of our imports is looking like it's not going to come, or at least not as dramatic as anticipated initially. But I think that's kind of a key topic to focus on here. Is there's a raging debate as to what are the inflationary and other impacts of tariffs. And so far it looks like Canada is sticking to its guns here. So we haven't seen any capitulation there. Quite the contrary. I think Trudeau was talking about some retaliatory tariffs on their end. And then you get into a full trade war because in Trump's executive order, if targeted countries that he imposes tariffs on retaliate, he then has the opportunity to retaliate back. So, I mean, you could really see this escalate quickly. And you think, just basically looking at the math in terms of the degree to which Canada, Mexico, China, and especially Europe rely on trade versus the US. You know, for the US, trade is a very small portion of GDP. I mean, exports are 12% of GDP. For Canada and Mexico, it's at least double that. And in the EU, it's, last I remember, it was over 50, 60%. And likewise for inflation. I mean, let's go back. We actually have an experience we can go back and look at with the Trump tariffs in 2018. He put tariffs primarily on China and steel in March of 2018. And if you look at the CPI and the PPI, 12 months later, they were both lower pretty significantly. So you didn't see the inflation pass through that a lot of people are getting so lathered up about, and is really the primary pushback to this tariff tactic, is everyone says it's going to be a tax on US consumers. Well, it wasn't the last time. And the key reason why is that in the case of China specifically, the Chinese government essentially subsidized the tariffs by giving money to its domestic exporters to offset the full impact of the tariff. So basically, Chinese companies that were selling goods to the US, let's say if the tariff was going to be 10%, they were able to lower their price by 10% so that net the US consumer wouldn't see any difference, and the government sort of reimbursed them on the back end. That's a very simplistic way of describing it, but that is what happened, and that's why our broad inflation numbers actually went down, not up. And if you think about the environment today versus 2018, obviously things are substantially different. But one of the key differences is that in the case of China and Canada and Mexico, economic growth for them is much weaker than it was in 2018. So one presumes, given their outsized dependence on trade with the US and their already weak economies, that the impulse to provide support for domestic exporters would be even greater than it was in 2018. So just viewed through that lens, one might expect that the pass-through wouldn't be as dramatic to US consumers, or, would be even less extensive than it was, to the extent there was any, in 2018. There are multiple objectives here. Number one is to just simply even the playing field, because, I think he's correct to point out that we've sort of been taken advantage of, or maybe put differently, we've let these countries sort of ride roughshod over us in terms of some of these trade deals where they have tariffs on their end on our goods, but we don't have them, on our end. So we're just trying to balance things out. Obviously, in the case of China, there's a major issue with, raping intellectual property, that whole thing, and he has yet to really address that. But I think more broadly, he's also trying to reinvigorate domestic manufacturing and to bring a lot of things that we've outsourced. I mean, one thing that he probably, I'm just speculating, was shocked like I was to discover during COVID was how reliant we are on the rest of the world for critical things, our PPE, our pharmaceuticals, all these things, let alone, basic manufacturing. I think his objective is just sort sort of bring a lot of that home? Why are we relying on, cheap labor outside the US to do all these things and risking, in some cases, our national security in the process? But also, why wouldn't we want to keep people here in the country gainfully employed? Now, this is where Michael Every's whole broader point about the shift from globalization to mercantilism, I think of it as a shift from globalization to more isolationism, whichever word you want to use. This has actually been underway for a while already. I mean, I would pinpoint that it really started to shift when our housing bubble burst. The bedrock of this whole move for globalization, which really was ushered in under Ronald Reagan and Gorbachev in the early 80s, was this US consumer as the epicenter. So it was really, globalization was carried on the back of US consumers who bought things from all over the world, and the world collected our dollars and recycled them into our markets, effectively lending us the money to keep buying their goods. And the US consumers' insatiable appetite for all of these things helped keep this ball rolling. And then in 2005, when the housing bubble burst and consumers realized, we can't borrow to sustain a lifestyle that's beyond our reach forever. I mean, what happens if, we're borrowing against things that actually go down in value and we suffer, the experience of leverage in reverse? I think they realized this is not a responsible way to live. And consumers, after the housing bubble bust, and we all know this to be true, really shunned leverage or debt for a long time. It took them a long time to kind of be willing to run up credit card balances. And then they only did it really because they had no choice. So I would say this whole vendor financing quid pro quo that was the framework of globalization and ushered in this tremendous boom in global trade was abrogated by the housing bubble bust in 2005. And more than that, by our response to it, where we just we undertook quantitative easing, and then setting that precedent encouraged all the Western central banks to follow. So all the major developed world debtors who were participants in this and the world reserve currencies started debasing their currencies wantonly. So between consumers in the US who no longer had this endless conspicuous consumption and our wanton debasement of the money we were paying for this stuff, I think that this whole globalization era, which started in, the early 1980s, really came to an end about 20 years later. And we've been just kind of slowly moving toward a more isolationist tendency. And then, of course, you get someone like Trump who comes in and seizes upon that and points out, these inequities in the global trade, but also what it's done in terms of hollowing out our own domestic manufacturing base, and maybe in some respects, you could argue widening this skew between the haves and the have-nots, because you basically have cut out a lot of the high-paying jobs working, used to be if you worked in an auto factory, that's those manufacturing jobs, those skilled labor jobs were high-paying jobs relative to sitting at the drive-thru at McDonald's and that sort of thing. I guess my broader point is we're focusing on Trump as leading the charge on this, but the seeds were sown years ago, and we've been moving steadily in this direction. And sure, he may be accelerating our process down that road, but we were always going this way. The concerns about the inflationary consequence of the tariffs sort of missed the point in a discrete way, just because, again, those economies will be more inclined to try to figure out a way to not get those tariffs passed through to U.S. consumers. But also, the broader inflation threat comes from what we were just talking about, which is this shift from globalization toward isolation. And you just have to look at what happened to inflation and interest rates over the 2 decades that we ushered in this great era of globalization from early 1980s through the early 2000s. You saw massive disinflation and lower interest rates almost entirely, I would say, because of this erosion of borders and this open free trade. So one would expect the opposite to be true, that as you move from globalization toward a more isolationist policy, both here and around the world, that you're talking about an environment where inflation will on net be higher. But that's a much more long-term secular framework. And I think people's concerns about the tariffs have been more about in the next few months, we're going to see the CPI go right back up to 5% or something like that. And I just don't see that. My opinion about tariffs and their inflationary consequences is really irrelevant. It's what does the Fed think? They are concerned that the tariff threat would reignite inflation. So if anything, it looks like just the idea that he's using this as a tactic might lead the Fed to be more reluctant to cut interest rates. The greater volatility, generally, the worse it is for headline indices. When you overlay the VIX versus the S&P sort of thing, volatility is not a great thing. And I think we're going to be living in an era of increased volatility for a while, not least because of the tweeting, but also because of the higher for longer interest rates. And it's a new paradigm. You know, we lived in a world of 0% for a long time, and a whole lot of stupid stuff happens at 0%. And we're starting to harvest the fruits of that. I mean, you saw last year the largest number of corporate bankruptcy filings since global financial crisis. And then for private equity funds, their portfolio companies had the largest bankruptcies on record. There's a lot of stupid stuff that happened at 0%, companies that got financing that never should have existed in the first place. And we're just starting to rationalize all that malinvestment. But there's a lot more of that to come. And the longer that rates stay at these levels, the more of it we're going to harvest each day. And I do think that that will be a headwind for the markets in general. I've always talked about, you know, a reversion to the mean in terms of market cap to GDP or other valuation metrics suggests we could get a 50% haircut easily. You know, it just sounds insane to say something like that, especially when the market's reversing course like it is today. So clearly it's going to take some persuading, but there's so much air under this market that I think you're totally right to point out that eventually when they do realize, hey, you know, my thought process maybe isn't correct, and they stop digging their heels in, having this reactionary response, it could get really ugly very quickly. But I'm chastened from having expected that. And honestly, we've talked about previously when the Fed started raising rates, I was like, well, this is just a matter of time before the you-know-what hits the fan. And here we are. I mean, sure, we've seen a ton of corporate bankruptcy filings, which is validation that there's real stress in the system. But when you look at risk assets broadly, they don't seem to be reflecting any sort of deterioration in credit quality. So the hope springs eternal that all of the negative impact of higher rates will be cured by stronger growth that is ushered in by this, you know, new sort of deregulatory pro-business fiscal policy. So we shall see.